You know, it's so easy to get impressed by those giant revenue numbers we see in the headlines. But today, we're going to peel back the curtain and talk about the one number that tells the real story of a company's success: profit margin. Because at the end of the day, it's not about how much a company makes, it's about how much it gets to keep. All right, so let's imagine this. You see a headline flash across your screen: Company X hits $1 billion in sales. Your first thought is probably, wow, they are absolutely crushing it, right? But here's the question: does that huge number actually mean they're successful? Well, the answer might not be what you think. It's a hard no. Okay, so this is where profit margin comes in. It's the key to everything. In super simple terms, it's just the percentage of money a company actually keeps after all the bills are paid. And I mean all the bills. It's that simple idea we keep coming back to. It's not what you make, it's what you keep. Let's put a number on it to make it really click. Say a company has a 35% profit margin. What does that actually mean? It means for every single dollar that comes in the door, they get to pocket 35 cents. That's the profit. The other 65 cents, poof, gone. It went to paying for everything from salaries to rent to the cost of the products they sell. Now, here's where it gets interesting. That final profit number doesn't just appear out of thin air. It's actually a journey. There are 4 different levels of profit that we need to look at to really understand what's going on inside a company's finances. Think of it like a big funnel. At the very top, you pour in all the sales revenue. Then, right away, some of it leaks out to pay for the direct costs of making the product. That leaves you with gross profit. Okay, from that, more drains out for things like marketing, R&D, and salaries. Now you've got your operating profit. Next, you've got to pay interest on any loans. That gives you pre-tax profit. And finally, the taxman takes his cut. What's left at the very bottom of the funnel? That's the bottom line we always hear about: net profit. So you can see how each of those steps tells its own little story, right? But the one that gets all the attention, the one we're really focused on, is that final net profit margin. Why? Because it's the ultimate report card. It accounts for literally every single expense, giving us the absolute clearest picture of how healthy a business really is. All right, so we get what it is, but so what? Why should we care? Well, it turns out this one little number is a pretty big deal to a lot of important people. Let's talk about who's using it and why. The short answer: pretty much everyone with skin in the game. You've got the business owners and managers themselves. They're using it to steer the ship. You've got lenders and banks checking it before they'll even think about giving out a loan. And, of course, investors. They are poring over this number to decide if a company is worth their hard-earned cash. Yeah, for the people running the business, profit margin is kind of like the check engine light in your car. If that number starts to drop, it's a huge warning sign. It forces them to pop the hood and ask the tough questions. Are our costs getting out of control? Do we have too many employees? Is our warehouse full of stuff nobody's buying? It's the diagnostic tool that helps them find the problem before it's too late. And if you're an investor, it's all about the side-by-side comparison. Imagine you have 2 companies in the exact same industry. One has a consistently higher profit margin than the other. Which one are you going to bet on? Probably the one with the higher margin, right? It's a huge signal that they're running a tighter ship, they're more efficient, and they might just have a competitive advantage that can mean better returns for your portfolio. Okay, and this is a really, really big but. You absolutely have to be careful. You can't just compare any 2 companies. This brings us to probably the single most important rule when you're looking at profit margins. Context is king. Here's the bottom line. Comparing the profit margin of, say, a software company to a grocery store is completely meaningless. It's a classic rookie mistake. A number that looks amazing for one business could actually be a sign of disaster for another. It's all about the industry they're in. And this chart just lays it out perfectly. Take a look at the tech giants up top, Microsoft and Alphabet. Their typical quarterly profit margins are way up there in the high double digits. Now look down at the retail giants, Walmart and Target. Their margins, low single digits. I mean, it's not even close, is it? It's a night and day difference. So, does this mean Walmart is a failure compared to Microsoft? Absolutely not. They are both wildly successful. It just means they're playing 2 completely different games. Tech companies sell high-margin products where they make a lot on each sale. Retailers like Walmart play the volume game. They make a tiny bit of profit on millions and millions of sales. The business models are just fundamentally different. So let's zoom out a bit and look at the bigger picture. You can pretty much sort entire industries into high-margin and low-margin camps. Over on the high-margin side, you've got software and gaming. And it makes perfect sense, right? Once you've built the software, the cost of selling one more copy is practically zero. It's pure profit. Same goes for things like pharmaceuticals or luxury brands. Now, on the other side of the coin, you have the low-margin industries. Think transportation, car manufacturing, agriculture. These businesses are what we call asset-heavy. They have massive constant costs for things like fuel, steel, and labor. So, of course, their margins are going to be way thinner. And, to really sum it all up, one source I read put it just perfectly. It called profit margin the globally adopted standard measure of the profit-generating capacity of a business. That says it all, doesn't it? It's not just another number. It's the standard. It's the universal language of profitability. So, from now on, when you see one of those headlines screaming about massive sales numbers, you're going to be way ahead of the game. You'll know that the big number doesn't tell the whole story. And you'll know to ask the much, much smarter question. Yeah, that's great, but what's their profit margin?